Hi, my name is Brian Schreiner. I'm president of Schreiner Capital Management, and I wanted to take a moment today to talk about what we might expect in the way of investment market returns over the next 10 years. Unfortunately, a number of factors suggest that returns over the next decade are likely to be very low on a historical basis. But how low is low? What are the risks? And what will the opportunities be? The purpose of this video is to help you think through the implications of what it will be like investing in what we are calling a world of low expectations. In a series of articles last year in The Economist magazine, AQR, an investment research firm, studied PE ratios and dividend yields, and they project that the real return from a 60-40 stock bond portfolio is likely to be about 2.3% per year over the next decade. That's about the worst expected return since they started collecting this data back in 1900. The PE ratio and dividend yield calculation includes measuring current stock prices. Both stocks and bonds are near all-time highs. Of course they can go higher, but anytime the price of an asset is near its all-time high, the price is expensive on a historical basis. So stocks and bonds are expensive today, but how expensive are they? This chart shows PE ratios going back over 100 years. The price to earnings ratio is a simple measure. It just takes the company's market price divided by how much the company earns over time. And when you look at current PE ratios of the S&P 500 stocks, it's in the 91st percentile of all of market history. In other words, stocks are more expensive today than they've been in 90% of market history. To put another way, only 10% of the time have stocks been more expensive than they are now. When have they been more expensive? Well, just before three major market crashes. Right before the 1929 crash, which sparked the Great Depression, right before the tech bubble, which imploded in 1999, and also the more recent financial crisis, which was touched off in 2007. So are investors concerned about this? Well, it depends. If you talk to them, they definitely seem concerned. But if you look at the most common measure of stock market volatility, how investors are actually acting in the market, it looks like they're not in the least bit worried about a potential crash, at least not in the near term. In fact, last week the CBOE Volatility Index, which is the VIX, closed at its lowest point in the last 7 years. So to sum things up, stocks and bonds are expensively priced. Return expectations over the next decade are very low. And it's pretty clear that the global economy is not as healthy as it could be. So how are markets reacting to all this? Well, as you can see again here on this chart, very calmly. It's kind of eerie if you ask me. At Schreiner Capital, we never try to predict when the next bull or bear market will come. Instead, we allow the markets to tell us when to invest and when to rotate into cash. We do this by measuring market trends or momentum. By seeking to invest our clients' assets when markets are strong and avoiding markets when they're weak, our goal is to provide them with a smoother, more predictable stream of returns. Although the outlook for investment returns over the next 10 years is pretty bleak, there's always plenty of opportunity to make money in the stock market. Our investment team looked at market data going back to 1950, and on average, the S&P 500 index fluctuates almost 30% a year. So despite the fact that returns measured on a year-to-year basis are likely to be low, opportunities will come and go constantly and create opportunities for investors who take an active, trend-following approach to investing. I hope you enjoyed the video. We're still accepting new clients, so to learn more about how to invest with us, contact us by email or telephone. And for more videos, market commentary, and research, please be sure to sign up for our free weekly newsletter.